Over the last 14 trading days, the US stock market has dropped over 10%, putting it into the correction territory. Reuters reported a market loss of $4 trillion. Investors are panic selling. So what's going on? Join me as I dive into the market shakeup. I will also talk about my strategy on how to invest during this turbulent time. First of all, what's causing all the market volatility? In February, Trump announced tariffs on China, Mexico, and Canada. Then he postponed them. Then he announced that the tariffs would go ahead. In a recent spat with Canada, he threatened to impose a 50% tariff on Canada's steel and aluminium. In retaliation, the Premier of Ontario said he would impose a 25% surcharge on electricity from Canada. Then, within a few hours, a deal was struck. Trump backed down and the Canadian side suspended the electricity surcharge. This back and forth is giving financial markets whiplash. I mean, how are you supposed to react? Questions are, will the cost be passed on to consumers? What is the impact on US producers? Will it cause inflation to go up? More scary still, will this cause a recession? All this created a lot of uncertainty. And what the market hates the most is uncertainty. The sell-off started and gathered momentum as people sell first and think later. So the question here is, should you sell, buy, or hold? To answer that question, let's take a step back and put things into perspective. In the long run, the market always goes up. It's a proven fact. Look at this chart. In the 40 years from 1980 to 2023, the market kept moving up through recessions, financial crises, and bank failures. Through the Asian financial crisis, global financial crisis, 9/11, and COVID-19, it just marched all the way up. But it doesn't move up in a straight line. Rather, it moves in waves of ups and downs. So the market's rise and fall in the short term is normal. If you had invested $100,000 in January 1980 and held on to it, that money would have become $11.26 million by February 2023. So why does the market keep moving up? For one, the US stock market is home to some of the world's largest companies and has a total market capitalization of about $57 trillion. And the best companies kept growing stronger, bigger, and better. Their revenues and profits keep growing. Secondly, most of the world's biggest funds are based in the US. So the US market has strong institutional support. This makes it less volatile than, let's say, the China market, which is mostly retail-based. In my opinion, the current market correction is just that, a correction, for now. By the way, what's the difference between a bear market and a correction? A bear market is where prices fall 20% or more from a recent high. A correction is when prices fall more than 10% but less than 20%. Here are also 4 reasons why I don't think the market is heading to a bear territory. Number 1, strong economy. Typically, a bear market is associated with a recession. During his address on 7th of March, Jerome Powell, the Fed chairman, stated that the US economy continues to be in a good place. The labor market is solid and inflation has moved closer to the 2% goal. However, one may argue that this is before inputting the effects of tariffs. How that will play out is too early to tell now. Number 2, Trump's policies. In CBS' recent interview with Commerce Secretary Howard Lutnick, he mentioned that Trump's policies are aimed at reducing the US trade deficit, currently standing at over $1 trillion. The idea is to bring manufacturing back to the US and create jobs for the American people. Trump has also proposed cutting taxes. The drop in internal revenue will be replaced by external revenue from tariffs, for example. Lutnick said that interest rates are expected to drop 150 basis points during Trump's presidency, and the stock market is expected to go much higher. Number 3, Trump's billionaire friends lost $209 billion from the stock market correction. It's no secret that Trump views stock market performance as a barometer of success. Any long-term price drop is going to reflect badly on his presidency. My personal view is he's not going to let it go into the bear territory. Number 4, cooling inflation. Tuesday's inflation data was positive, coming in lower than expected. The Fed had been on a mission to cut inflation from a high of nearly 8% in 2022 to 2%. Tuesday's data pointed at 2.8% against the expected 2.9%. The inflation rate is important because the Fed uses it to gauge whether to cut interest rate and by how much. Interest rates have an inverse relationship with the stock market. Any rate cut usually sparks a rally. This time, the inflation data is not low enough to signal a rate cut until at least May this year. Now, it's important to remember that we're looking at February numbers, which hasn't taken into account any repercussions from tariffs yet. Now, for the million-dollar question, what should you do with your portfolio? Number 1, very important, stay calm. Don't let panic dictate your investment decision. Remember this, emotion is the enemy of profits. Number 2, invest in high-performing funds rather than individual stocks. Look, you are not Warren Buffett. You don't have an army of analysts doing research for you. You don't have the time, money, nor knowledge to accurately pick stocks. Investing in ETFs or mutual funds allow you to ride on the fund manager's expertise. Let the best and brightest minds on Wall Street work for you. Number 3, stay invested and dollar cost average consistently. It's tempting to cut loss and put your money into cash. That can protect your capital in the short term, but timing when to reinvest is challenging. If the market rebounds unexpectedly, you will miss out on the gains. It is impossible to time the market. Research shows that going in and out of the market will cause you to end up with far less than if you had just stayed invested. Now I'm talking more about ETFs and mutual funds. Buying in at a lower price will give you more units. So when the market recovers, your gain will be higher. My clients do dollar cost average by investing monthly. And number 4, trust historical patterns. When the market is oversold, rallies typically follow. That's all for today. I hope you enjoyed this video. See you in the next one. Bye-bye.